Welcome back, students who are taking financial accounting, and in this the last video that we're going to do for the theory for chapter 9 on current liabilities and long-term debt, we are going to, let me get down to that slide, and we're looking at the focus on decision making. Don't blow this off, okay? In this textbook they give you 2 or 3 ratios at the end of each chapter. But realize that you've already had most of these ratios if you've had the subject math for business and finance or math applications. So this material really shouldn't be new, and also realize that you're going to have it again in managerial accounting. Okay, and just as a quick aside, I had a student who on the exam, it was for managerial accounting, the final exam, the questions were worth 5 points each. So the last question had 5 ratios, and she had gotten 4 of those ratios wrong. Now remember, that's the 3rd time she's having these ratios, okay? She shouldn't be getting any of them wrong. And the sad thing about it is that that final exam is open book. It's unlimited time. I mean, you're doing it at home. It's not like it's a proctored exam. And she still missed 4 out of 5 questions. And what ended up happening is because she had lost 4 points, she actually failed the subject with a 69. Okay, when the reality is that she should have gotten all of them right. That was the gimme question in order to, that was the easy one. All right, because you've seen it 3 times. So, here in financial accounting, you're seeing these the 2nd time, but don't blow them off. They are important, and that's why you keep seeing them again and again and again. So the first one here is the debt ratio, which, as you can see, is total liabilities over your total assets. Okay, and basically what this ratio does is it says, do we have enough assets to be able to cover our liabilities, right? And the book gives you the example of having $425,000 in liabilities and $685,000 in assets. So we have a positive number, right? That positive number is good. Okay, obviously I have, if I went out of business, I had to liquidate my assets to pay off my liabilities, I would actually have money left over, and that would be the net worth in the business. Okay, so having a positive number is important versus a negative number. Now, in doing a comparison from one accounting period to the other, whether that number goes up or it goes down, okay, what does that mean? Okay, I mean, they are still positive numbers, so that's still a good thing, but, do you want that number to go up or do you want that number to go down? And I'm not going to go working through the scenarios, but here's my suggestion, right? Take that, take these numbers and play with them and see what happens and think about what happens. Well, instead of having 425,000 in liabilities, say I had 325,000. Okay, what would that end up being? All right, how much would that be? What would be the effect? Or instead of 425, call it 525 in liabilities over 685,000. What would that be? Okay, or you can change the assets. So you can increase your liabilities or decrease your liabilities and see the effect. You can increase your assets and decrease your assets and see the effect. Okay, and think that through. I'm not going to go through all the math for that. Do it for yourself, but I highly recommend that you do that so that you understand, the effects of increasing and decreasing liabilities and assets, how it affects your debt ratio. Okay. Now, interest coverage ratio, right? Let me erase this here so I can use the whole screen. So we have earnings before interest and taxes over interest expense. All right, so earnings before interest and taxes. All right, what does that mean? All right. we all know on our income statement, and this is where this shows up, and you'll hear about EBIT and several different forms, but basically what it means is we have our revenues less our expenses gives us our profit or loss. Okay. Now, generally, we at this point in time, we know what our profit or loss is, and I'm just going to make up a number here, 50,000. Okay. Is that our true profit or loss? No, right? Why? Because we have to pay, at the very least, taxes on that profit, and we're going to pay the taxes out of that profit. Okay. So that's why it's called earnings, because our profit or loss here is our earnings before, okay, and the two things for this particular ratio is interest, any interest payments that we have to make, and taxes. Okay, so and I'm just going to just make up a number here. Let's say interest on this 50,000 is 10,000. So this here profit or loss, let's just call this 50,000. And say our interest is 5,000. No, let's make it 10,000. 10,000. And our taxes, now remember we're paying taxes on the 50,000 here. So let's just say that happens to be $5,000. Okay. So we subtract out our interest expense and we subtract out our taxes. And that gives us our net income or net loss for that particular accounting period. So in this case here, we actually have a net income of $35,000. Okay. So, up until this point in time, when we've been talking about profit or loss, we've been trying to use that terminology synonymous with net income or net loss. Okay, but the reality is it's profit or loss. It truly isn't the net. The net actually ends up after you take into consideration your interest and your taxes. Okay, which then gives you your true net income or your net loss. All right. So that's the whole thinking behind earnings before interest and taxes. All right. And so when we're doing this calculation, all right, if we have this as our net income or our net loss, well, our earnings before interest or taxes in the numerator would be 35,000. Okay, because I'm sorry, 50,000. Oops, looked at the wrong number. It would be 50,000 because it's our earnings before the interest and taxes. We don't just take the net income or loss. So realize that now in your thinking, when it comes to doing analysis, you have to keep in mind as to whether you are talking about profit or loss, or you're looking at net income or a net loss. You're going to have two separate ways of thinking about doing your analysis for the same exact, for not the same exact thing, for something. You're going to have to think about it from the perspective of profit or loss, or whether it's net income or loss. So just realize that there's a divergence in the way you go about analyzing the information. Okay, so the book, and let me just make up some numbers here in order to more align with the book. All right, let's say that our earnings before interest and taxes is $20,000, and we have an interest expense of $10,000, and we have taxes of say $2,000. Okay, so our net income or loss, we're going to have an income of $8,000. That's going to be our bottom line. But now when we look at our interest coverage ratio, and as you know, I'm like using, if you read slowly and you think about individual words, I use those as a mnemonic to be able to help me understand what I'm looking at. In this case here, interest coverage. So can we cover our interest? And the earnings before interest and taxes was $20,000. Okay, and our interest is $10,000. So that means we have a 2.0 interest coverage ratio. Okay, so we're covering our interest, from our earnings 2 times, right? Again, play with the numbers and see the effect. I mean, if we increase or we decrease our earnings, or if we increase or decrease our interest, obviously that's going to make the ratio either go up or it's going to make it go down. All right. So play with, do the extra calculations to see whether that goes, the effect of it going up or it going down, and think about what that means. I'm not going to, go through those 4 iterations, but you could do that yourself. And I do highly recommend that you do it at least once, so that it gives you an idea, because you will have, situations come up not just on a test, but even in the real world where, it's going to be 2.0, and then maybe in the next accounting period it's going to be 1.85. Okay. And you're going to have, as part of your analysis, comparative analysis, what does that mean? And if you run the iterations of that, just like for the debt ratio, work it out the 4 different ways, it'll give you a better understanding as to what that actually means and whether it's good for you or bad for you. Okay. All right. So with that said, again, if you don't understand something, rewatch the videos, rewatch it. And if you still don't understand something, feel free to telephone and speak to an instructor. But, that's it for the theory videos for Chapter 9. And, from here, we're going to be working on, the short exercises, and the problems. So I'll see you in those videos for that.